We will now start with the first panel, Will the Global Minimum Tax Suffice? And we will begin with our keynote speaker, Michael Keane, former Deputy Director of the Fiscal Affairs Department at the IMF, and it will be followed by a policy discussion.
Well, let me perhaps begin. I'm not sure if you can all hear and see me, but I guess someone will tell me to shut up if you can't. So, let me say first of all what a great pleasure it is to be here, at least virtually. I'm sorry I can't be there in person, so I'm afraid you'll have to put up with an increasingly old-fashioned, I hope, Zoom presentation. So what seemed helpful for me to do in 15 minutes or so is really just to go through some of the economics of Pillar 2 and at least have an opportunity to raise some of the issues that I hope will be taken up in the panel discussion. So perhaps a good place to begin is, well, what are we actually trying to do with Pillar 2? What's the objective? And sorry, I have a little screen issue here. So what we're trying to do, I think we can say there are two key concerns that Pillar 2 is trying to address. One is to curb, but certainly not eliminate tax competition, underlying which I think is the revenue, or not least, there's a fairness concern, but there's also the revenue concern that we've just heard described to us. So that might be objective A. Objective B is curbing profit shifting, the artificial transfer of profits to where they are taxed at relatively low rates. Now, whether that's an end in itself, of course, one could discuss if it's some notion of equity at work there. But clearly, it's also part of the objective is to help to ease tax competition. That is to serve also objective A. I think there's a further objective, which has seemed to me, I'd say, a little bit subsidiary, at least in how the politics has played out. And that's to try to alleviate tax-induced distortions to investment. I think particularly investment in terms of the allocation across countries. I think one point maybe worth noting there is that there is a bit of a tension between, on the one hand, the desire to raise what is in effect average rates of tax to get more revenue, and on the other hand, to try to reduce distortions to investment at the same time. In principle, the way to resolve that, what we try to do to achieve those objectives of raising revenue whilst reducing distortions to investment is to find ways in which we can collectively increase average effective rates of tax, AETRs, while at the same time having marginal effective rates, that is the rates that determine essentially the overall level of investment, given that level is going to occur in some jurisdiction. We want to try and have those close to zero. So that's in some sense the wider trick. And I think one can say that, when we look at the overall success of the BEPS program and the Pillar 2 in particular, I think that those are kind of two dimensions one would like to see maybe more explicitly evaluated than I think has often been the case, at least in much of the policy-focused debate on these issues. And certainly I think we want to have a tax system that at least leaves countries with the opportunities to set low marginal effective tax rates, even if we have views on what an acceptable average rate of tax is. The trick that I'm not yet sure we've completely figured out how to do is to at least leave countries with opportunities to set low marginal effective rates of tax. And I think that's also one reason why in the medium to longer term, further reforms of the corporate tax will still come under discussion. And maybe in some sense, other structural aspects of corporate tax reform have been a little bit neglected in the past few years, given this focus on international considerations. I think it's helpful to say a little bit about the mechanics of the Pillar 2. It's going to be a little bit of algebra here, but I really think it pays off, and you can of course reach the same conclusions by numerical examples for people who like to do things that way. So here's the basic structure, and here I'm following notation of a very helpful paper by Mike Devereux and colleagues. So essentially, how do we impose the minimum tax? And interestingly, no one had really thought until the last few years about how you'd actually impose a minimum tax. Been a lot of conceptual talk by academics and so on, but no one had really figured out how to do it. And I think OECD deserves a lot of credit for actually figuring out how to do it. So here's how the top-up tax would work. For an entity that that is a member of a within scope multinational, that is a multinational with group revenues of more than 750 million euros. So we have a top-up tax which is applied in this way. You take 15% and you subtract from that what's called the globe ratio, the tax ratio, which is the ratio of covered taxes P to accounting profit P. You take that difference and you multiply it by the excess of accounting profit over what's called a carve-out, the substance-based income exclusion, which is calculated as fixed proportions of payroll and tangible assets. And that little term P minus C, profits minus the carve-out, is called the excess profit. Important thing to note here, why I'm partly going through this, is that when people talk about a minimum tax of 15%, it isn't really a minimum tax of 15% because of this carve-out. The carve-out means that we're not simply talking about topping up to an overall rate on accounting profit of 15%. So if we think about, so that's just the top-up part. If we think about what total tax is, we end up with what you see towards the bottom of the screen. And the important point there is the second equation. There's simply, there's a term that essentially cancels out when you think about total tax, which is top-up tax plus domestic tax. What you end up with is the total tax, and I think this is a useful way to think about it, is the sum of two things. One is you pay tax on your carve-out C at the basically your effective tax rate determined by domestic taxes as globe ratio T over P. You pay that, so you pay the covered tax ratio on your carve-out, plus there's a term which is 15% of profits minus carve-out, 15% of excess profits. And what's important here, I think, is that second term, the 15% of P minus C, that is a kind of absolute minimum. That is the lowest you can go because of the imposition of the Pillar 2. So that's the real minimum tax. I put absolute minimum-ish because there's one little qualification that I'll touch on later. So here we have, I think that's a useful expression to bear in mind, and I'll come back to it. Another point I think worth noting is that that second term, the tax on excess profit, actually has some similarities almost to a rent tax. If C there was, for example, a normal, the investor's required return, that would be essentially something like an allowance for corporate capital scheme. It would be non-distorting, and it would be a tax on profits in excess of the minimum required by the investor. And that alone would have some attractions. Many economists like rent taxes. And so that puts in my mind at least one question that I haven't seen as explicitly discussed as might be helpful, which is, well, is that actually a deliberate design feature to try and have the top up or the absolute minimum being in the form of a rent tax? Is that deliberate, or is it something that we could build on to try and build perhaps a more non-distorting collective approach to taxation? It's not clear to me that is the intention, given that the carve-out changes over time, and over the transition, and it's not kind of calibrated to be a rent tax. But nonetheless, I think that's an aspect of the scheme that is worth kind of discussing and building on. I should say a little bit about, of course, one of the key issues, and if I can move the thing on, is the question of, well, who actually gets the money when we oppose the top-up tax? Well, for many key issues, also say that actually doesn't matter. Things like what is the impact for investors doesn't really matter who gets the revenue. Investors presumably don't care who they pay the money to. They care how much tax they pay. But just said, and cutting here a very long and controversial story short, the model rules give priority to essentially the parent side, the parent country, a parent of going up through the parent chain under what's called the income inclusion rule, the IIR. But a very important and I think helpful addition to the structure late last year was by allowing for the host country where the income arises to essentially preempt the parent company by applying its own top-up tax under what's called the qualifying domestic minimum top-up tax, if I've got that right, the QDMTT, which I think is a very helpful innovation. My only concern is that OECD didn't exercise their usual brilliance in thinking of acronyms for the QDMTT. I think we need a special name for that because it's a very important tax. And of course, a clear policy prescription when we think about Pillar 2 from the point of view of countries is that it's a good idea to apply a QDMTT, because if you don't apply a QDMTT, then either countries outside, either the kind of parent company is going to impose the tax instead, and you're basically just leaving money on the table. You could raise the revenue and have no impact on investors by applying the QDMTT. Or I suppose you could think, well, I'll stay out of the system, but I'll make sure that my effective tax rate is at least 15% so that the top-up won't apply. The trouble with that is that will leave you with a higher average tax rate than if you were in the system and imposed the QDMTT, because you would, under the QDMTT, your average rate, because of the carve-out, is going to be less than 15%. So imposing your own 15% is not such a good news for investors. So it's the scheme, I think, is very rather brilliantly designed to give strong incentives to participate in this respect. There is also provision for what's called the under-tax payments rule, to be imposed by the host if the IRR isn't implied, and there's an envisaged subject to tax rule on some payments. I'm going to leave those aside here just for brevity. I'm sure they'll come up in the discussion. So let's talk a bit very briefly about what the impact of these measures might be on the various things we're interested in. Well, we're interested in profit shifting. And so what's going to happen there? Well, typically the marginal rate on shifted profits will now be, I should say, actually not around, it'll be at least around 15%. Because if you shift to a country that's now been obliged to raise its a country to which the minimum applies, then essentially the rate is going to be around 15%. So we'd expect profit shifting to fall, but we certainly don't expect it to end, in part because, well, it might not be, if you're in a 25% jurisdiction, shifting to 15% is not so good as shifting to 10, but it's still better than nothing. So profit shifting won't, and the question is of how much it might fall. And of course, there's some empirical work on that, but here's just a little kind of back of envelope example to give you a sense. Well, there's some evidence that the amount of profit shifting is kind of convex, non-linear in the tax differential. It's bigger the larger the tax differential between a high and a low tax country is. So suppose profit shifting was simply proportional to the squared difference between the high and the low tax rate. So A is here just some factor of proportionality, but it actually turns out to not be relevant for the calculation. If you look, suppose, for example, the low tax is initially 8%, then profit shifting from a country where the rate is, and I can't see my own screen at this point, with a rate of 25%, that's going to fall, you can figure out, by about 65%, which is a lot. It's going to fall by even more. The lower is the initial tax rate, and the closer is the higher tax rate to 15%. So these aren't small numbers. Of course, they're very crude numbers, and they ignore, for example, the fact that, well, some profit shifting may already occur to countries with rates above 15%, and that may continue, it may even increase. But nonetheless, I think, and the empirical work, I think, tends to bear out under a kind of a range of assumptions that one has to use to address this issue, that the impact on profit shifting could indeed be quite marked. What about the impact on tax competition? That is how countries will react. Well, if we think about countries that are directly affected by these rules, which broadly speaking are largely investment hubs, a few others, well, recall from the earlier slide that this is what the total tax is. We have the absolute minimum there. The only thing, if you're a country, the only thing really you can directly control is that first term, the T over P term, the rate that comes off your domestic taxes. So if you look at this, essentially what happens is that the effect of incentives, low tax rates, are largely not wiped out. Note that the T over P only has an effect to the extent of the carve-out. So, for example, reducing tax by $1 no longer benefits the investor by $1. It doesn't cost you $1 either. Those magnitudes are going to be less. But nonetheless, there's still an impact of incentives and low rates, preferential regimes, and so on, so long as the carve-out is strictly positive. The little kind of qualification to the absolute minimum label I mentioned below is that the only way you can really go below the absolute minimum through the tax system is by what's called a qualifying refundable tax credit, which is essentially just a spending measure. So let's see what we might think for low tax countries. To me, it's not really very clear that there's a great impact on the incentive to reduce their domestic taxes. What about higher tax countries? Well, they now have less need to guard against profit shifting, reducing some competitive pressure on them there. So the question becomes, well, what will their strategic response be? So we've seen that, the Pillar 2 certainly sets a floor, this absolute minimum term, but is this also going to be a ceiling, in the sense that other countries may feel pressure to reduce their rates to be in line with Pillar 2? Well, there's some evidence, I think, that tax rates are what's called strategic complements. If that's the case, that would mean that actually there will be increased rates. Higher tax countries will tend to increase their rates in response to this reduced pressure to guard against profit shifting, and that will then actually dampen the adverse impact on low tax countries. But again, some of this evidence, as in much of this, the evidence from past experience is a little bit hard to go on because we really have seen nothing like this before in terms of coordinated reforms. But nonetheless, that would be my initial take on that issue. What about the impact on tax revenue, which has been a large part of the purpose? Well, aggregate revenue we would expect to increase both directly in countries or circumstances where the minimum bites and indirectly through reduced profit shifting. And there are some numbers out there. I think when you look at the global estimates, they may be in the range of 1.7, 5.7% total corporate tax revenue, 5.7% probably on the high side in terms of some of the estimates. And our own colleagues and friends at the Tax Observatory have done some work on this, which I think, if I've sort of rescaled everything right, means an increase for the EU of around 15%. Of course, the allocation of that's for the total revenue. Who actually gets the revenue depends on whether there's a QDMTT in place. Having said that, one striking finding in a recent report just out last week from UNCTAD is that actually that matters less than you might expect. The real business in terms of revenue fact comes from this profit shifting, the reduced profit shifting, not so much from the direct impact of the minimum itself. I think OECD and some of their estimates find these two effects are about 50-50 in terms of their impact. UNCTAD, I think, find a much higher effect from the profit shifting alone. Another point there, I think, is what I was just saying about the strategic response, that is what the high tax countries may do, matters a lot. So the IMF in their recent fiscal monitor finds that actually that can more than double the revenue gain that I mentioned on the previous slide. So the strategic response really does matter. And then I just wanted to say a little bit about the impact on investment, going back to one of the themes at the part of that I mentioned at the start. Well, if we think about average effective tax rates, clearly we'd expect those basically to go up. They go up both directly and they go up indirectly because the ability to reduce profit shifting is a way of reducing our effective tax rates. So even in countries or circumstances where the minimum doesn't directly apply, the reduced opportunity to shift profits outwards may be expected to increase average rates. Also, we might expect average effective tax rates to become more compressed, that is to be in a kind of a narrower band. I know Mike Devereux has some nuances to that argument. But let me stick with the simple case for the moment. So what would that mean? That means average rates become more compressed, differences are smaller, which means there's going to be a diversion effect, which actually favors, in relative terms, higher tax countries. And that's going to lead to presumably that will lead to an improved cross-country allocation of investment, going back to that objective C that I mentioned at the start. So average effective rates matter kind of both particularly for where we think investment will take place. Maybe not so much for the overall level of investment, so long as the average rate's not over 100%. What may matter for what we typically traditionally think of as mattering for the levels of investment are marginal effective rates. The impact on the last dollar of investment, how much do you invest until the tax system means you don't cover you only just cover your required return. Well, those marginal rates, again, we'd expect to go up in all countries because of the reduced profit shifting opportunities. And that's true both in countries that are experiencing outward profit shifting and those that are experiencing inward profit shifting. Both of those are in this sense adversely affected in terms of marginal effective rates. In countries that are more directly constrained, actually, the effect is a bit complicated. It's even possible that the marginal effective tax rates could go down. And this is partly where the carve-out is important. So if the carve-out, for example, provides for more than the required return on the investment, that is, if it's rather generous, the carve-out is then actually means the minimum tax component is more generous than a rent tax. It's actually, in effect, a marginal subsidy. So it's logically conceivable marginal effective tax rates will go down. Nonetheless, I think most of the analysis suggests at least the more intuitive outcome that marginal effective rates will go up. And you can give some examples. If you have accelerated depreciation, which involves slightly more complicated mechanics than I discussed earlier, but nonetheless, let me stick with an example. Accelerated depreciation, the proportionate increase in marginal effective rates simply equals the excess of the 15% over the minimum, over the initial low tax rate. So those are some of the, I've really just tried to introduce at least some of the primary issues for consideration. I have a whole bunch of questions that one might address. How do we know if 15% is the right number? How would we change it? There's an issue about the undertax payment rule and its subordination, in effect, to the income exclusion rule. How important is that, given the application, particularly of the QDMTT? The issue of how high-tax countries respond and how low-tax countries respond. And I think just an issue there is simply, well, okay, in some sense, we're talking about the kind of tip of the corporate tax iceberg in terms of the application to just, for the moment at least, these very large multinationals. What is it going to mean for the corporate tax that applies to the other companies, the entities that are going to be out of scope? How will things change? How will things change there? Have we fully understood the impact on investment in FDI? I'm not sure. And what will Pillar 2 mean for corporate tax reform more generally? I think some of these issues we've rather set aside over the last few years. Is it going to encourage, or is it going to inhibit movement towards more effective, potentially effective, non-distorting revenue raises in the form of rent taxes of various kinds? So I think I will leave it there, if I may, and just to note that when the PowerPoint's available, there's a whole bunch of papers that can be useful and interesting on that. So with that, I think I will thank you for your patience and hand back to Brussels. Thank you.
Hey. Alex, must be me. You can't be on the end. I'll be on the end.
Great. Well, thanks very much. Great to be here. My name is Sam Fleming. I'm the Bureau Chief of the Financial Times here in Brussels. And it's a great pleasure to be here for a fascinating topic and a really excellent conference as well. It was obviously an enormous breakthrough, the OECD deal, a year or so ago. So it's a really good time, I think, now to assess what it means as we get closer into or deeper into the process of trying to implement it and see where it's likely to change tax behaviors and what are the most important impacts we're going to see. We have an excellent panel to discuss that. Let me introduce everyone very briefly. Immediately to my left is Pascal Saint-Amans, who's the Director of the Centre of Tax Policy Administration at the OECD. Then to his left is Alex Cobham, who's the Chief Executive of the Tax Justice Network. To Alex's left is Kira Peter-Hansen, who's a Danish MEP from the Greens EFA group and the Vice Chair of the Subcommittee on tax matters. And then finally, to the far left is Michael Devereux, who's from the Centre of Business Taxation at Oxford and Professor of Business Taxation. So, as I say, an excellent panel. Thanks very much, and everyone for joining me. Let me start very, very high level, because, as I say, we are more or less a year on. How big a leap forward does Pillar 2 in particular, but the overall deal represent, and how big an impact do we expect it? And I will give that question to Pascal. So I'm asking you to talk your own book on this one. How revolutionary do you think this actually is?
Good morning, and thanks for the invitation. I mean, it's not the OECD which qualified the agreement as historic, but many countries, starting with President Biden. So there must be some truth in there. And the reason for that, it's a package. It's not only Pillar 2, even though I tend to think that Pillar 2 is absolutely massive. It's probably the end of a cycle which started in the 90s, where countries realized that there was tax competition. They started shy with saying harmful tax competition, because there was no agreement that tax competition was not great. And then the work on harmful tax practices kind of didn't deliver what it should have delivered. We moved to BEPS. We tried to patch the system. And we also realized that in spite of some good progress, the end of hybrid mismatches, limitation of interest deductibility, which at the time with low interest rate was not that big, but in the coming times will be quite important, there were still holes. And I think Pillar 2 is a way to put an end to the race to the bottom at a rate which some will say is not high enough, but 15% effective. And that's extremely important. It's an effective rate. It's not a nominal rate. And 15% effective based on financial account is actually quite important. Combined with an agreement that the existing share of taxing right is not appropriate, which is what Pillar 1 says, basically. On the rent, it recognizes that market jurisdictions don't get enough. And in spite of all the difficulties for Pillar 1, because it needs to be ratified by all parliaments, including US Congress, and you know that the separation of powers in the US is such as the administration cannot commit Congress, which makes the bar pretty high. But in spite of that, there is the recognition that we needed a new system with stronger regulation, the minimum tax at a significant level, agreed by all countries. I can tell you that was not easy to get there, with the recognition that the current system needs to be repaired because taxing rights are not enough in the market jurisdictions. And on the top of that, the recognition which started already almost 15 years ago with the exchange of information and building tax cooperation, but that in a global economy, in a globalized economy, we had the need for cooperation, coordination of tax system. And the fiction of sovereignty, we are sovereign from a tax perspective, this was a fiction and no longer a reality when high net worth individual, I mean the seminar is about offshore wealth, right? But also large multinational companies could arbitrate one sovereignty against another. The only solution is about cooperation and coordination, which I think Pillar 1 and Pillar 2 will achieve, in particular through the extremely deep level of information exchange.
Thank you. Alex.
So look, I think we tell the story slightly differently, just a global rather than an OECD perspective. But I agree largely with Pascal's characterization. If you go back, though, to the 1960s, at a time when the United Nations, and particularly the G77 group of developing countries, is trying to impose some control on multinational companies, that's the stage at which the OECD members established the OECD and moved tax out of the UN and into the OECD. And that's really about saying we are the host, the home countries, rather, of these multinationals, and we will determine the taxation. So the concerns of lower income countries that they're not able to tax in the place where the economic activity takes place are really pushed aside for decades. And that makes sense for OECD countries because they're not really losing out. You know, Aimé Césaire's boomerang has not yet landed. So in the early 1990s, US multinationals are shifting perhaps 5% of their global profits, according to our analysis. So it's not a big issue. But by the early 2010s, US multinationals are shifting 25 to 30% of their global profits, and that's hurting OECD members as well as lower income countries. That, coupled with the fiscal pressures of the financial crisis, means that we get for the first time a consensus, and the G20 gives a mandate to the OECD with a single goal, that we must align profits, taxable profits, better with the location of real economic activity of multinationals. And that's what the OECD and Pascal's team have been doing for 10 years, trying to get agreement among their members to make that alignment better. Now, coming to Pillar 1 and 2, the problem we have is this. You know, Mick has given a great presentation about the extent to which Pillar 2 can both reduce the variation in effective tax rates and reduce profit shifting. The reason that's complicated, though, is that this was supposed to be done with two different tools. Pillar 1, in the original ambition, would have shifted us to a unitary taxation system so that all profits would have been taxed according to the location of sales and ideally of employment too. We'd have dealt with profit shifting by making it more or less impossible, except at the margins. And then Pillar 2 makes sure that the incentive for profit shifting is also eliminated because we're paying a reasonable effective rate everywhere. Unfortunately, Pillar 1 has collapsed into something very small, and we're really here talking about a Pillar 2 that struggles to do both pieces. I think we'll come on to who will get the revenue benefits from it, but the issue that's left is that at the minute, Pillar 2 is going to force competition between conduit jurisdictions that want to continue to attract profit shifting, against which there is no effective measure, and home countries that want to keep taking a disproportionate share of revenues. Whether this actually reduces the revenue losses, even of home countries, is unclear. And for the host countries, that are mainly lower income countries, it certainly won't do that. So this remains an open problem, unfortunately.
Thank you, and nice to see all of you. It's been a long time since COVID that we have these discussions. And I share the assessment that this deal is historical, and that we've come really far on this. Just in my lifetime, I'm not that young, I'm not that old, but in my lifetime, the average corporate taxation in Denmark has decreased with 12 percentage points. So we've really seen this race to the bottom, and this OECD agreement can absolutely do something about it. Then I also think it's important that we discuss how to go faster, because I think this is not the only solution, and there's also still some loopholes in regards to tax competition. And some of the worries that I have, Michael spoke about it before, is the refundable tax credits. I think here there's a risk that we will see member states and countries over the world give these subsidies to countries, and I think this is something we need to be aware of, as well as what you said, Alex, the difference, or like the relation between the host countries and where the tax is being allocated. So I think there's a lot of things that we need to look into when the deal is implemented, but for now it's a really important step, and hopefully it will be adopted really soon.
We'll come on to adoption in a sec, but before we do, Michael, just give your overall assessment.
Yeah, thank you very much, and thanks for inviting me. I have mixed views. On the one hand, this is an unprecedented agreement. Congratulations to Pascal. This is really something new in the last 100 years, really. So it's really huge. And I think I should confess that a couple of years ago I thought it wasn't going to work, that it would be impossible to get agreement among so many countries, because the incentives of countries to take part would not be there. Now, I was thinking, why would the UK, my own country, want to do this? By the way, the UK, since I've been working on this, the UK has reduced its tax rate from 52% to 19%, so it's gone quite a long way. Why would the UK want to do this? Surely it can attract more inward investment by staying out. And I think the way that actually Pillar 2 has been put together has really dealt with that. I mean, actually, if the UK doesn't tax it, somebody else will tax it. And, there's all these different levels which Mick referred to. So I think there is, I think it probably will work. And I think, so we've done some empirical work also on how many countries would need to introduce this in order for it to work. And I know Pascal has talked before about needing a critical mass. Well, a critical mass, I think, turns out to be kind of relatively small if you get the big countries. So if you get the G7, most multinationals are somewhere in the G7, they'll be captured. So the G7 would probably, if the G7 did it, we'd basically be there, I think. So that, I think on the one hand, that's fantastic. I think, the kind of other part of me wants to refer back to what Gabriel said earlier on, which is, we should be thinking about a tax system for the 21st century. What's the, as it said, policies for tomorrow. So what I worry about, on a broad scale, is is Pillar 2 in particular. This is a way of propping up the existing system that we've had for 100 years. So my question is really this the kind of basis of how we want to tax multinational profit for the next 100 years, or should we be thinking of something different? Maybe we'll come on to those questions.
Great question. We will come back to that. Before we do, let's talk a little bit about the politics of this and where this deal stands, because a deal of among 130 countries it needs then to be implemented into national law. Are we on track, Pascal, especially in Europe, but also obviously in the US? These are the two jurisdictions where we've seen the most headlines about delays. Europe obviously is coming up to a meeting at the end of this week. ECOFIN could be in a moment where we could see Pillar 2 at least implemented, but let's see. And then there's the big question of the midterms looming in the US and the embattled state of the Biden administration. So how do you assess things?
Okay, we're in Brussels, right? We're on Monday. So let's meet on Friday in Brussels. There is an ECOFIN which will be quite important. So the logic of Pillar 2, as Michael said, is having critical mass. That's why we didn't make it a minimum standard, an obligation. By the way, I'm the OECD, but there was 141 countries at the table, 137 agreeing the deal, and the Global South agreed the deal, and Macky Sall, who's the chair, the president of the African Union, last week said, fantastic deal, historic deal, fully supportive, good for us. I won't speak on behalf of Africa, I just repeat what Macky Sall said last week. So you have all these countries, and what's interesting is you need a first mover to start the domino effect. So who's going to be the first mover? I think everybody expects that Gerasimos, Benjamin, and Mr. Gentiloni will be the one triggering the first move, and we hope it will happen on Friday. I would say I'm pretty optimistic, maybe because I'm not in the EU inner circle, but I'm optimistic that on Friday there could be a deal. If there is a deal on Friday, then it's likely that the US will move. Whether immediately or a bit later, it requires Congress to move. But why is it so important to have a first mover, and why is it so important for the US administration to have Europe move? Because if somebody just grabs the tax, your tax, well, you will not let it go, you will act yourself. And you may have noticed, Michael mentioned the G7, but we could extend to the G20 and developing countries as well, that all the G7 countries at least have announced that they will move by year-end, with an entry into force probably at the end of 23 or early 24. So the dynamic is very strong, even though we would like to see this first mover, and we hope that Europe will do it. And finally, you can see that a number of countries from the south, but also countries with a low effective tax rate so far, thinking of Singapore, I'm thinking of the United Arab Emirates, where there is no corporate income tax, they have announced that they're going to move. Last and not least, and it makes me think of Jean de La Fontaine et le lièvre et la tortue. Switzerland is known for being usually, slow, very slow, but they were the first one to announce that they will implement Pillar 2 starting in 24, and maybe actually they will be the first one on the arrival line together with the European Union.
Just let me come back to you quickly on this before I pass it to the other panelists. Matthias Cormann said a few weeks ago in Davos that discussions are difficult. Agreement could come into force perhaps in 2024, so later than expected. And I know we're focusing here on Pillar 2, but clearly Pillar 1 is a bigger question mark, especially in the US, and was one of the reasons why Poland in particular wanted to link the two pillars really closely because of the concern that actually you only get half the bargain.
So as the panel was on Pillar 2, I was not trying to avoid the
I
question
know,
on Pillar 1. So happy to respond on Pillar 1. Yeah. Pillar 1 had something like an impossible deadline, which was set for political reasons last year, which was an entry into force in 23, requiring in 7 months' time the development of multilateral convention on something which is unprecedented. It may not be enough, but still, it's a move to unitary taxation with absolutely new concept written in stone, because what you need to do is not a model rule that you can adapt easily, but a multilateral convention which needs to be ratified by all Congress. So saying implementation will be 24 is not really saying, oh, it's delayed, we are in bad situation. It's just stating the obvious, right? So we are actually in the midst of an extremely intensive negotiation. People negotiate as if their life was depending on this. Now, it's very easy to say, well, you know what, this requires Congress ratification in the US, it will never happen. So if you want to look smart today, you say, this will never happen. And you state something which is pretty obvious, very difficult. But when you dig further, and when you think of that, first you may say, the first ones who said you need a multilateral solution requiring a multilateral convention, where? US Republican senators. It's on the record. That's not obvious, but it happened. Second, the deal per its nature, I think, is largely bipartisan. Third, if you look at the counterfactual, if there is no implementation of Pillar 1, then you have something like unleashing unilateral measures, having trade tensions, and having a situation which is difficult. Fourth, what for? For 40 US companies in scope, a number of them, if not most of them, willing to have this solution which organizes peace. So I'm not saying, oh, US Congress will ratify. We all know that it's difficult to assess. It's for US Congress to decide, and US Senate probably with a large majority. So it has to be bipartisan, which means that this needs to be factored in. And it's not, this doesn't mean that we reduce the chance of this happening, but rather the chance of this happening are not that slim, even though the first assessment to look smart is, oh, it's not going to happen.
Kira, could I ask you, but in the Parliament, how do you see the timetable now, especially on Pillar 2? Do you think, and what kind of deadlines are you setting, and how quickly do you think we could move on Pillar 1 as well?
Yeah, we actually just had a mission to Washington in the tax subcommittee, and here also we discussed that it's important that we of course move and that we also keep the midterm elections in mind. So I think that's a really important point to ensure that both the EU and the US actually adopt this. From the European Parliament side, we are also crossing our fingers for Friday. What we unfortunately saw, and many of you might already know it, was that Poland was vetoing it because of the recovery and resilience plans that the Commission didn't want to grant them. So there's been this kind of unfortunate situation where the OECD agreement was taken in as a hostage by the Polish government, which is really unfortunate, but I think also going to what you said before on making a tax system fit for the 21st century, I think this also shows some of the lacks of the unanimity that we have in the European system when it comes to taxation. So, but in general, we are hoping for Friday, and I think that's the best opportunity that we have, also given the situation in the US that we need to move on Friday.
Alex, when you talk about implementation, as Pascal said, actually an awful lot of countries, including in the Global South, have signed up to this. So is there not a sense that actually momentum is moving towards this in a significant way and potentially quite rapidly, at least on Pillar 2?
So I think it's actually swinging the other way, but let me go back and say I do think this is historic. And I do, we welcome this very strongly, the idea that you would move. Well, for context again, when Tax Justice Network was established in 2003, we called for unitary taxation and we proposed an end to the race to the bottom. And both of these things, in principle, are in Pillar 1 and 2. So this is, over 20 years, an extraordinary shift, given that these were originally written off as completely utopian and unrealistic. Suddenly we're here, or at least we're talking about them. And Pascal and his team deserve a lot of credit for having brought the international community along this road. But we shouldn't think that the inclusive framework, because it has that word in its name, is inclusive. Of the 140 odd jurisdictions, a number of them are not countries, they're dependent territories of OECD members, and the take-up has been greatest by the corporate tax havens who see the qualified minimum tax as a way to protect themselves. Lower income countries in groups like the South Centre, the African Union, the African Tax Administrators Forum, the G24, all have called out the lack of inclusion in the framework, that their voices have not been heard in the way that they think they should. Macky Sall, who you mentioned, is the chair this year of the African Union. And the African Union, or the Economic Commission for Africa, members have just collectively passed a motion calling for the UN to begin negotiations on the UN Tax Convention to challenge profit shifting and base erosion because they do not think the OECD deal delivers revenues for them, which is broadly what the UNCTAD findings that Mick referred to confirm. So I think we'd like to see the EU take this through, but only in a way that doesn't tie its own hands to go further in future and doesn't tie the hands of lower income countries to be able to take different decisions, because they need that freedom if we're not going to persist in a position where lower income countries lose the biggest share of their current tax revenues and have the least voice in setting the international rules.
Michael Devereux, can I ask you to pick up some of those issues then? I mean, are some of these concerns justified? Do you think that are you as worried as some of these jurisdictions clearly are about whether their voice is being heard and whether this will actually work for them?
Yes, I think there's. I may agree. It may appear that these two are disagreeing with each other, but actually, I'm not sure that they are in effect. So I mean, I'm not in politics, but I mean, if anybody can make this work politically, it's going to be Pascal. And so good luck to Pascal in that difficult job. I would say, I mean, I agree with Pascal that there is a tendency to close down debate about tax policy on the grounds that, okay, we think this will never happen. And I've been proposing outlandish tax proposals for years, and that's the kind of thing that people say. So here, I think this is a kind of proposal which 2 or 3 years ago people thought wouldn't happen and is likely to happen. I think the issue of, I think it's almost certainly the case that, the African members of the inclusive framework, for example, didn't get as much say as the US. That's hardly surprising, and I can't really see that changing, even if you go to the UN. It's still going to be the case that the bigger, more powerful countries are going to have a larger role and a larger say. That may be unfortunate, but that's probably just life. Whether they're actually worse off or not, or whether they could do better in some other circumstances, is more difficult to say. It's not clear to me at all that they would be worse off. I mean, especially given, as Mick was describing on the video, the QDMPT. I mean, the who gets the money now has changed dramatically as of December of last year, and I think before that, it would have been the kind of big capital exporting countries. That seems to be no longer the case, and I think so I think lower income countries who have some inward investment, but the profits from that inward investment are being shifted to tax havens, they should do much better. And I would have thought they will be doing better. I'm not sure I fully understand their position if they're against it.
Pascal, let me ask you a little bit about how you think countries are going to respond. Mick mentioned the question of what high tax countries might do, but also low tax countries. What's your assessment really in terms of the behavioural responses that we now expect in terms of policy?
I don't necessarily have a full-fledged response to your question. We'll see. That's the best assessment I can have. What I see, however, is that this is going to happen. And whether it's on Friday or a bit later, there will be a global minimum tax which will be implemented everywhere. And that raises the question of who's going to get the money. And it's true that the initial assumptions may not be right. I have always personally thought that, contrary to what a number of people said, and not only the NGOs, including, among the OECD countries and others, so it's more a debate for economies, but that source countries, developing countries or market economies, and they are not always the same, but would get more than we initially thought they would. That the rule order, which was something that a number of negotiators focused initially on, was not that important, precisely because of the top-up tax. That's how I call the QMD whatever. I don't like the acronym either. So the top-up tax. And a number of havens, of low-tax jurisdictions will do a top-up tax, and maybe some of them will get the income, and some of them will not get anything because there will be no longer profit located there. So it's hard to say. Some of them will get it, some others will not get it. But one thing which strikes me, and I will disclose my travel schedule today, I'm flying to Jamaica later today to meet the co-chair of the Inclusive Framework, who's from Jamaica, but also to attend a conference of the free trade zones. And I think that's something which has been underestimated, the impact on tax incentives, in particular wasteful tax incentives in developing countries. Developing countries are losing points of GDP, of lost revenue because of tax incentives, and Pillar 2 is a great leverage beyond the companies in scope to get this back without losing the investments. I know there is an UNCTAD report which was just issued saying, oh, there will be a negative impact on investment. I'm pretty sure that MIC or others would disagree on that and will be working on this, because our sense is that you can actually increase the revenue without losing the investment. And the correlation that if you increase corporate income tax, you will lose investment is not sound intellectually. Otherwise, it would mean that if you want to optimize the investment, you should get rid of corporate income tax. So, unclear response to your question, because it's not clear. We'll see what happens, but it will probably be much more even than a number of people thought.
You'll not be surprised, I don't entirely agree. I think what we're seeing with the QMDTT thing is, you know, a change in the type of competition we're going to see, right? It will become very attractive to compete on the side of the carve-outs. And the more aggressively you can do that, as Mick showed, the lower the effective rate that you can actually offer. And given the absence of a restriction on profit shifting, the lower the effective rate you can offer, while being able to demonstrate that your jurisdiction is aligned with Pillar 2, and therefore nobody else can come in and further top up these taxes, the more attractive it will be to shift profit into those jurisdictions. And the question then is whether, for lower income countries, that's a game that it's worth them starting to play, in which case we're effectively into a new and more global race to the bottom, or if that's really a game that's just played between those conduits and the home countries, in which case lower income countries continue to be outside it and continue to suffer from profit shifting and don't really care if it's the home country or the conduit that's taking their taxes. Either way, it's an outcome that feels further disempowering. And I think that's the fundamental issue here, and it's why we're going to see the momentum build for this UN convention that the African Union has called for. It's why a set of UN experts wrote to the OECD and others earlier this year to say the way that tax rules are set is effectively still imperialist, because it has these consistent outcomes in terms of who is heard and in terms of who gets the benefit. So this feels historic in the sense that we've crossed a line about whether unitary tax is the way forward, and it is, and whether we should be drawing a line under the race to the bottom, and we should. But the mechanisms that we have at the minute as a result of the negotiations that have been done, the dominance of the US and France, do not allow us to achieve those aims. So that's the next chapter, if you like, for international tax. It isn't one of certainty, and after 10 years we can all say, thank God we never have to talk about BEPS again. It's going beyond the OECD to find that more global space for discussion. That, as I say, is why I hope the EU doesn't tie its own hands, that they do a deal that brings in an effective minimum in the EU, but in a way that allows them and others to go further later.
Kira.
You know, I think that's an important point, and I think here also the Commission's tax imposition is going to be quite interesting, because I think, and also going to your questions on what will the member states do and the countries do, then of course the question is also what should they do from a political perspective. And I think there the main fight that we have to take is to not make this a top-up or like a maximum 15%. So to ensure that countries, especially those countries who currently have a corporate taxation rate higher than that, will not lower it, and that this is not perceived as like now we fix tax systems for the next 100 years. I think this is something that we can build upon, where we can also look at what is working. There's also going to be like in a couple of years when we had the implementations, we're going to see what is working and what is not, and to take that opportunity to improve it. And also looking at what Gabriel said in the beginning, we see multiple crises, so there's also a need for environmental taxation and discussion on that. So the discussions on taxation is definitely not over with this, and member states need to be aware of that.
Michael, could I ask you about this question which was just raised about investment and the impact investment? Well, how do you assess the likely behavioural effects in terms of investment from the tax deal?
Yes. I mean, I think it's quite complicated, as Mick was he had a slide on this, and it kind of depends a bit on which bit of profit you're going to tax. I think Pascal said, if you get rid of corporate tax, will you have more investment? In general, I think yes, you would. I know in general, corporate tax reduces rates of profit, and that creates a disincentive to invest. And it depends a bit on how you do it, as Mick was explaining. If you're only taxing economic rent, then in principle, that shouldn't have the same distorting effects as if you're taxing the normal return to capital. But in general, I think that's what we'd expect. Now, I think there's two different things going on here. One is that it may be that if the total amount of tax paid on profits in the world goes up, and that's not just on economic rent, although it may be because this is the minimum tax is 15% on excess profit. But if it's a bit broader than that, then overall there'd be some disincentive to invest in greater than we have at the moment. The other issue is are we going to invest in country A or country B? And then I think economists worry about distortions due to tax there. Perhaps country A is the best place to invest, but it has a high tax rate, so we go to country B. So that's the kind of distortions that we might worry about. The interesting question is, if we implemented Pillar 2 in the way that's envisaged, will that actually reduce the dispersion in tax rates across countries and make that distortion less likely, or will it increase it? And I work on that, and Mick referred to this. It's it could go either way, but actually, on average, we find that it doesn't really make much difference to that dispersion. So I don't think, in terms of the distortions to location decisions will not be greatly affected by Pillar 2, I think. So there may be some broad effect on the total amount of investment, but location decisions, on average, probably won't be affected very much.
One particular question I had was about the famous GILTI in the US, with the Global Intangible Low-Cat Tax Income rule, which is a US measure obviously aimed at discouraging profit shifting. How does that work with Pillar 2? How does it how does that interact, and what do you see them doing with it?
That's a very interesting question. First, without GILTI, we would not have a minimum tax. And this is, about paradoxes. It's very interesting. It's a Republican administration and Congress which adopted a global minimum tax with GILTI to start with. Relatively low rates, and the big difference with what we've done is not only the rate, but also the fact that GILTI appreciates the effective tax rate abroad on average, and not on a country-by-country basis. Which means that in a simplified model where I have half of my profit in France, half of my profit in Cayman, the average is above the 10-point-something% of GILTI, which means that GILTI, per design, organizes tax planning. What we've done, and when I say we, it's this collective inclusive framework, where the conversation started on addressing the tax challenges of the digitalization of the economy, and when, interestingly, the Trump administration and the US in general, because of Michael and Andrew Auerbach and a few others, were pushing for the destination-based cash flow tax, which was a debate in 2017, the US administration said, you know what, you, the French, you want to tax Google, Apple, Facebook in the market countries, maybe you're right. We need to give more taxing right to the market. Let's resume that conversation on Pillar 1. And when resuming that conversation, Germany, Olaf Scholz, France also said, we want a Pillar 2. We want to have what you've done. It's a bit the same story as with FATCA. You suck all the information out of Switzerland, we want the same, and that's where we did the common reporting standard, automatic exchange of information. There, the French and the Germans said, like kids envious of a new toy, you have a global minimum. We want the same, so we want to do that in the negotiation. And the Trump administration said, why not? Because, the more join the party, the better it is for us in terms of leveling the playing field. And then the divine surprise was with the election of Biden making this the top priority, with a level of ambition which was much higher, and which allowed us to design it on a jurisdictional basis. So you look at the effective rate on a jurisdictional basis, not on an average across the board, a worldwide average. And that's where GILTI is kind of the mother of Pillar 2, but now, I mean, the kid has grown and is much better than the parent. And that's why guilty needs to be amended to be in line with Pillar 2 and with the GLOBE rules. And how to align it? You have a plan, and I think our members, because it's not for the Secretariat to decide, but I think our members consider that the plan being discussed in the US will make guilty compatible with Pillar 2, designating it as a CFC legislation and making it work, which means that US companies wouldn't have to face an under-tax payment rule because guilty would be compliant. I think that's the reflection of what the membership currently thinks. And that brings us back to your first question. Will it happen? I tend to think that yes, but let's go back to Brussels on Friday.
I'm going to open it up to questions from the audience shortly. So start getting your questions in mind, so we have plenty of time for that. Before I do, I'm going to ask one last question to our panelists, each of you, in terms of business. What comes next? I suppose the very broadest question possible. This is obviously a big step forward, but if you were to name one particular priority, what would it be now looking forward? What's your most burning issue that is left unaddressed, effectively, by the two pillars? Alex?
I think we'll see, in one context or another, the negotiation of a full shift to unitary taxation. And I think that will bring with it implications for minimum taxation, but it will be focused on that unitary tax shift. My guess is that we're going to hear a lot more about a UN tax convention, even in the next few months. You know, the collective ministerial resolution from African countries has really brought that to the top of the agenda. And I think a sense that, you know, even if the EU and perhaps even the US were to deliver on what they've said in Pillars 1 and 2, it's not the end of the story, it's not the end of profit shifting, and it's not the end of the race to the bottom. So I think for high-income countries too, there's still something to discuss, even though everyone is tired after 10 years. I guess just to pick up on, you know, I think, Pascal, you make exactly the right analogy with FATCA. You know, the US does FATCA, and then the EU is able to make multilateral the automatic exchange of information. But who doesn't join? The US. And where are we left? Well, we're left with the US as number one on the financial secrecy index because it's the one major financial center that refuses to share information with other countries. Are we going to see that dynamic here too? It seems increasingly possible, let's say. And does that matter if the EU does something good and the US doesn't join in? Where does it leave everyone else? Maybe it makes it easier for lower income countries not to have their arms twisted and not to be forced to do something that isn't very good for them. But that gives you back this world of potentially the explosion of unilateral measures. And I think it may be that, as much as the positive momentum for a UN convention, that brings people back to the table. If Google is still facing serious taxes in other countries, because of the lack of taking this forward, they're going to be pushing the US and others to get around the table again. So I think the answer is we're going back to negotiations. Sorry, Pascal.
I may break some news which will be a big shock for Alex, and I'm sorry about that. But the UN includes all countries in the world, and it also includes the US, the Europeans, and many others. But that's shocking, so I will just shut it down now.
It does, but they negotiate in a different type of transparent
sure,
forum
and consensus
with agreeable voting.
Absolutely.
It's not a silver bullet, it's not the answer, but it gives you a chance that you don't have within the rich countries club.
Sure.
Kira.
Yes, well, besides having the two of them agree on the OECD deal, then I think, as we've said, this is a really important landmark, and I think the implementation is, of course, going to be the most important. And then I think, from a political perspective, ensuring that this is not going to be something where countries just rest and think that everything is solved, and then looking at the still different loopholes that there are in this agreement is going to be really important. And then looking at a bit broader, I hope something that we can come forward to is also to see that we have this minimum corporate taxation, that we can also ensure on, for example, carbon pricing. I think this would be the next step, but it's going a bit further than the minimum tax. But I think that's what I'm looking forward to.
Michael?
Yeah, I largely agree with the other speakers, surprisingly. I mean, mostly anyway. I think this is where I came, if I could return to where I started, which is, so we have this great new agreement, is it a suitable system for the next 50 or 100 years? And I'm with Alex. I think in the sense that what this is doing is really building on what we have at the moment in arm's length pricing, and we're trying to figure out how much profit a multinational makes in each particular country. And the denominator of this effective tax rate, which is crucial here, is the amount of profit you make in this country. And that's quite difficult to determine. Most of the existing problems that we have in the existing system are to figure that out. Did I make my profit in Belgium, in the UK, and the Cayman Islands? These are quite difficult questions given the existing system. But we're kind of maintaining that within the existing system. And I think if you think of that effective tax rate, which Mick put on the slide, it's essentially the tax that you pay, the covered taxes, divided by financial profit, as measured by accounts, with some adjustments. But I think the notion that we have here is actually, the denominator there is a true measure of profit that you've made in this country. And I think that's very tricky, both conceptually and in practice, to kind of figure out what that is. So I'm actually with Alex in the sense that I don't think the arm's length pricing agreement, which we have, and which has basically been the basis of the system for the last 100 years, is actually sensible for the next 100 years. Exactly where we go from that and how we reform that, we could discuss in another session. But I think that would be, that's my fear, I guess, is that we're actually kind of cementing those kind of problems into the system, and it's going to be more difficult to change now because we've actually reached this agreement.
Pascal, you wanted to come back on one point there?
No, just to add a word to put things in perspective. I think, over-focus on corporate income tax, which is what, 10% of the revenue of countries, and you asked a very open question. There is much more than corporate income tax, and probably all spend too much time on corporate income tax. We need to fix it, but there is much more about that. Personal income tax, progressivity, how do you address the level of inequalities? I mean, again, that's the title of this conference. This is something extremely important, I think. Global mobility. I mean, in a post-COVID environment, where do we tax Mick for the presentation for which he's heavily remunerated? Where is this remuneration taxable? Is it here? Is it in Japan, where he is, or something like that? I don't know. That's a big question. Last and foremost, environment. I would be probably less optimistic than you are, but I would like to support you on carbon taxation, because every time a country moves there, you have riots or gilets jaunes or whatsoever. That's what we need to do. That's where we need to concentrate the effort, with extremely difficult question between the global south and the north. Extremely tricky, extremely difficult, but which has to be addressed, and that's going to be difficult. So I think the next 10 years will be about that, and it has to be fair to the global south, and it's extremely difficult. But that's where I think we need to put our efforts now on.
Okay, over to you, the audience. Please do let me know your name when you raise your hand. We already have a question over there, please.
Hello, thank you very much for an interesting discussion. I'm Sune Bertelsen, new chair of the Business Europe Tax Policy Working Group. I didn't really hear you talk about what would this mean to business, what would this mean to job, to research and development. How come you don't have more focus on these areas?
Okay, thanks very much. Who shall I start with? Pascal, we can start with you, but I think also Michael, if you have thoughts on that would be good. Yeah.
I do think that what business needs is a stabilized environment with more tax certainty. We haven't talked much about Pillar 1, but it's part of the package, and Pillar 1 is about a fairer reallocation of taxing right, coming up with tax certainty, and without a fairer distribution of the rent of the largest companies, you cannot have tax certainty. And what business should care about, and tells us they care about, is to pay taxes only once. The problem is that today, or for the past 20 years, taxes were paid nowhere, too often, resulting in frustrated tax administrations doing aggressive audits, or frustrated tax policy makers trying to fix the system, but without coordination, you have, issues of double taxation. And very often I've been frustrated by the lack of real support of business to try to fix the system, to say, we're compliant. Why the issue was not compliance, the issue was the policy currently is wrong and we need to fix it. And we had reluctance from business to fix the system. So I think we need to work together into that sense. Fixing a floor, which is the case of Pillar 2 of the global minimum tax, is a way to stabilize the system. We have to recognize that there is an impact on the complexity of the system, also for developing countries, because it's difficult to implement. We recognize that. But that's the price to say, to really put this safety net. The impact on investments, I think we've discussed. The overall assessment is the impact on investment will not be negative. It's just a way to secure the revenue of countries, and for the Global South, there is an imperative of domestic resource mobilization, which couldn't be done without fixing that leakage. So I think the perspective for business has not been ignored. We are working on the framework for the implementation of Pillar 2, which is extremely important to limit double taxation, to limit anarchy, because there is a risk, because the rules are complex, and that's where we're going to put a lot of emphasis, and there is currently a business consultation, a public consultation. I guess business there are on the front line to help design the rules in a way where we will limit the frictions.
Kira?
Yeah, I think also just quickly following up, I think for me the important aspect that we both as EU member states and also as the OECD can contribute to is the harmonization. And I think that's where we can really give also an added value to the businesses to ensure, as Pascal said, that they're only going to be taxed once. They know how they're taxed and they know that the rules won't change every year because one country lowers their income or their corporate taxation, then the next does it, and then there's different things you can withdraw from your tax sheets. I think making it harmonized is the best thing that we can do for businesses in Europe and the world.
Michael?
Yeah, I agree with Pascal about certainty. When I talk to business leaders, they talk about certainty a lot. They also talk about complexity. And one of my concerns about the proposals is really the way that the Pillar 2 rules are kind of layered on top of the existing system. So in an example of that, which people are thinking about now, is like, how does the Pillar 2 IRR rule relate to the CFC rules that countries already have? That seems to me to be, it's quite a complicated thing. It's going to create more complexity. At the moment, it's creating more uncertainty. And I guess, as an academic, I would say, look, you don't really need the CFC rules anymore. Let's just have one way of kind of having a minimum tax. If we've got two ways simultaneously of having a minimum tax, and we have to think through all the ways in which they kind of interact with each other. Now, I'm not blaming Pascal for doing this because it's an impossible job anyway to get in agreement here. But I think there are some problems with for business in terms of that. Certainty should perhaps be a bit better. R&D, I think, is catered for in the kind of proposals, and I'm not quite as optimistic as Pascal on investment. But I think the overall effects probably won't be that large.
Alex?
Just briefly, look, tax justice is a pro-business agenda, which I'm sure you recognise. If you think about how much your members spend collectively on tax advice each year, you have a definition of inefficiency in the international tax system. I think Gabrielle has just released a paper with co-authors looking at when Chile introduced OECD tax rules in 2011. They put in a lot of new rules in line with the international consensus. They received no additional revenue, but the companies in question spent an enormous amount of additional money on tax advice, right? And that, in effect, is the risk that we will see again here. I think if businesses and groups like yours were coming out saying, we want to cut through this, we want to go back from the League of Nations decision in the 1920s and go the other way. We want unitary taxation, so we have a non-distorting single assessment of tax at the global level, a portion between countries according to where the activity is, with no real room for games. We'll publish our country-by-country reporting so everyone can see it, and we can demonstrate to all the public, not just the government, that we're paying tax where we should be, and lose all of the reputational damage that the games that we end up playing in the current system cause us. everyone's a winner here. You know, it's not a case of seeing this as anti-business. It's quite the opposite. This would be the type of reform that gives business a clean sheet, a non-distortionary playing ground for investment for the future. It's, I don't know, it would be interesting to explore whether your members would support any of that.
Okay, any further questions? Right here at the front, please.
Good morning, all. Francesco Bungaro, European Commission, DG Competition, Fiscal Aid and Aggressive Tax Planning. So thanks all for this excellent, really excellent panel. My question is about even post-implementation, or maybe how to monitor the implementation. So we know that at some point, or I guess that at some point, the OECD will start looking at how countries have implemented. So I can imagine a sort of monitoring exercise. I'm just wondering whether, given the historic, as you said, the historical agreements, whether in this case, the OECD could also think at going even a bit further in terms of, let's say, assessing the way countries have implemented. So I know that for BEPS, for instance, we have been peer-reviewing jurisdiction, maybe issuing the recommendations on the way they have implemented or not, whether properly or not, whether in this case, you also envisage a system for that, and whether you could go even beyond the recommendation, because in this case, indeed, this is really important. So maybe for Pascal and for Alex, maybe that could be a question. Thanks.
Thank you.
If we talk about Pillar 2, there will be peer reviews. There will be peer reviews, which means peers, the 130 whatever countries which will have implemented Pillar 2. And it's extremely important that there is a common understanding and assessment of what the different legislations do, whether they're compatible or not. Otherwise, it will be really, really difficult for everybody. And I think we've been able to demonstrate that we can do peer reviews in a very inclusive manner. I think the Global Forum on Transparency, 163 countries today, 161. I'm a bit lost in computations because of Russia, Belarus being out of the groups now, but more than 160 countries doing in-depth peer reviews, so I agree with you. Now, countries are sovereign, all of them, and that's why they're reluctant, and they will never give up their sovereignty to an obscure technocratic secretariat, whether it's at the UN, at the OECD, and I think Benjamin feels the pain in the European Union, even though you have these special organization, institutional arrangements here. So yes, there will be peer reviews, and what I think is extremely important is the level, and I said it in the introduction, the level of coordination which is required for the new system to function. And I think countries have understood that. They now need to implement, which will raise a number of questions in an environment which deglobalizes. Is the G20 going to survive what's happening in Ukraine? This is still a live question. Will countries trust each other to do that? If they don't, I see a serious risk of reopening the way for tax havens. So this is a real risk that we are facing today. But this coordination and this exchange of information is absolutely key for the functioning of Pillar 2, and by design of Pillar 1. The in-scope companies, their tax regime will be decided by all the countries which will have signed and ratified the multilateral convention on an equal footing, legally. So we've moved to a brave new world at the time where this new world is a bit fragmenting, which is a question on the way forward.
Alex?
On Pillar 2, I think we can do the assessments of what's in law and what's in practice, and something like the Corporate Tax Haven Index that we publish has detailed assessments of that kind. We'll keep doing it. But actually, if you want to see who's playing the game, all we need is country-by-country reporting data made public. We need to understand for every company in every jurisdiction the effective tax rate and the scale of their economic activity. Now, the European Union is moving forward, making some of this public, but only for EU member states and a handful of others. We need that for every multinational company and every country. With that, you have the objectively verifiable data that you need to know if a jurisdiction has found a way of gaming it and they're attracting a lot of profit shifting with a low effective rate, or if everyone is more or less playing the game. Until we have that, we'll continue only to find out through leaks, whether that's of Luxembourg tax rulings or from the kind of analysis that the EU Tax Observatory does, retrospectively looking back when they get the data, the same with us at the Tax Justice Network. Let's have that every year in real time, give or take, and then we'll know. We'll know who's playing and who's not.
Kira.
Yeah, no, I think on the implementation side, it's I think Pascal and Alex knows better also how to ensure the implementation, but I echo what you say about the need for coordination between the different jurisdictions and between especially the EU and the US partners, and then I share fully the perspectives on the reporting. I think that's key to ensure the transparency in general in tax.
Michael.
I realise we're kind of running out of time, so very,
final word to you.
very briefly, I mean, the clearly implementation issues or issues to do kind of what happens in the event of disputes between countries, those kind of issues which, need to be resolved, I think. On the kind of data points which Alex raises, it'd be great to have that data, but it's not entirely clear, what we do with it. Is whether the Tax Justice Network gets this data and then can kind of produce a league table, or whether it just needs to go to tax authorities, because if the problem is one of enforcement, then that would be sufficient. So I think there are kind of more issues to be worked out on that.
Well, we said it an awful lot of times. I'll say it the final time. Obviously, a historic deal, incredibly important, but also an awful lot to play for, as we'll hear in our next panel. This is by no means the end of the story. So until then, please join me in thanking our panelists.
So before moving to our second panel, new forms of tax competition, we will have a 10 minutes of a coffee break, and we will resume around 11.